Hello and welcome to CPA Academy. My name is Chris Downey and I'm your webinar moderator host for today. Today's topic is R&D Tax Credit, General Qualifications and Law Updates. Today's presenters are Maggie Crowley and Devin Medrick. And before we take a deep dive into this topic today, folks, please leave your questions panel, pull that out to let me know if you can see me, see Devin, see Maggie, and see their very first slides. Also in this panel, let me know where you are located on planet Earth. We'd love to know where our attendees are coming to us today. And so I am seeing North Carolina, Maryland, California, Nashville, Miami, Florida. Welcome one and welcome all. If you have any technical question, you can use this panel to ask me a question and I will get to you as soon as possible. One other area of housekeeping is going to be your CPE credit. Today's class is worth 1 hour of CPE and 1 hour of CE credit. And the way you will earn that is stick around with us for 15 minutes of the allotted time and answer 3 of the 4 polling questions available to you. There's also a handout available for you to follow along with. And with no further ado, please welcome Maggie Crowley and Devin Medrick. Take it away, guys.
Thank you so much, Chris, and hello, everybody. We're so excited to have such a big turnout on a beautiful Friday afternoon. Hopefully this presentation will get you pumped up for the weekend. We are here today to talk about the Research and Development Tax Credit, which I'm sure many of you are aware. This will give you a deeper knowledge. And for those of you who are in the Boston area, we're hosting an event in our office in Downtown Crossing next week, and the subject matter is ERC. It'll also be available online, but if you come in person, you get to meet us, and we're having cocktails after. So there is a link within the chat, and we'd love to see you guys there. So let's start with a little round of introductions. My name is Maggie Crowley. I am head of our Strategic Development Department here at Leyton. And what that department does is we partner with CPAs to help you guys with some outsourced work that you might have a need for. We know how confusing and complex tax credits can be. We're the experts, and we just want to help CPAs have a one-stop shop, and that is what my focus is. And then Devin is a senior tax expert. He's delivered probably close to like 900 clients, ranging from various different industries. And I'll let Devin introduce himself, but I know he's a modest man and he probably wouldn't highlight the amount of people that he's, client engagements that he's had.
Yeah, nice to see everyone here. Just as a little background, I've been at Leyton for 3.5 years. Maggie and I both were, I think, the first 10 people hired, and now the company is up to about 250 almost 4 years later. So it's been really exciting to be a part of it. I came from PwC before that, worked there for a few years in international tax. I went to UMass Amherst. I've lived in Massachusetts my whole life. But yeah, great to see everyone.
Well, thank you, Dev. So here's our agenda for today. We're going to go over the history of the R&D tax credit. And the history, we want to review the history because it is important to see the evolution of this credit and how the government, and it's in place because they really want to encourage businesses to use this as a true strategy, not just a one-time claim. We've got some client stories that we'll share about how businesses have actually used this as a true strategy. And it's so nice to like see their credit grow and grow and grow throughout the years. And then we'll walk through how to identify qualified clients. And then we'll learn how your clients can take advantage of this. And, you know, of course, if people do want to outsource the R&D tax credit, we're here to help you. But if that's something you do in your firm and you want to refine those skills, we're here to educate you. So without further ado, we'll get into it. And if you guys, I wanted to mention this about the questions. If you guys have questions throughout the presentation, please pop them in the chat. We are going to try to save enough time to do a live Q&A. But if we can't get to the question, we will email you with the answer. probably on like Monday and Tuesday. So ask away, keep it in there, pop it in there in the chat, so you don't forget it. And we are going to do our very best to answer them live, but at a minimum, you'll get them via email. Oh, our first poll question.
Polling question number 1 is active on your screen, folks, for CPE, and it is asking, do you provide R&D consulting services to your clients? Make your selection now, folks, and this poll will be active for 60 seconds.
We need music for this polling section.
Hmm.
Do I have a career in music? Should I get out of the tax business, you think, and go into the music business?
Or amateur Jeopardy hosting, maybe.
Definitely amateur.
I have to put that in there.
I think the music was a nice touch.
Thank you.
You are welcome. We'll close this poll down, folks, in 3, 2, and 1. And I will show you the results really quickly here, folks. And we've got a majority at 57% are saying no, they do not provide R&D consulting services to their clients. So back to you guys.
Well, look at that. 57% of you are in the right place. No, everyone's in the right place. As I said before, we want to educate, help, and answer questions. So thank you for answering the poll. So just to tee it off, and then I'll hand it over to Devin, who is the expert here. But although I did start my career at Leyton, like talking with clients to pitch the R&D tax credit, and the R&D tax credit was initially introduced back in the 80s, and the purpose behind it was to help businesses have a sustainable way to actually fund what they're doing. So in the beginning, bigger firms like Google, Apple, businesses that were doing something brand new for a whole sector were the ones that were eligible for the credit. And the government saw what a great impact it had on the ability to help fund a business, because it is a dollar for dollar tax credit. And then they actually ended up making it a part of the tax code. And they had one major change, which we'll get into the details on it, but they made it more inclusive, and they allowed all sectors to have the ability to qualify. You just have to be doing something new for your business, not for an entire industry. So that's when it really became relevant. And I think that's why we're here today, because there are so many folks that don't know that change was made. So there are a lot of surprising industries that people are like, what? A dentist can qualify for the R&D tax credit? A brewery? We didn't know that. We thought it had to be like someone in a lab doing what most people define as research and development. But the definition of research and development, according to the IRS, is a little bit different. So we will get into the details on that today. So Dev, I'll hand it over to you to take us back in time. What was the R&D tax credit like back in 1981?
Yeah, so like Maggie said, first of all, it was originally a little more based on the way a lot of foreign R&D tax credits work, and they might be called something slightly varying from R&D tax credit. But for instance, in the UK, you need to be doing something unique to the world, essentially, to the country or the industry, developing something completely new. So first of all, just that stigma, I think, with the origination of the tax credit in the early 80s was attached to it, even though that was a little bit of a misconception. But originally it was not permanent. So, that's another reason why companies didn't bother learning about it or claiming, because they thought it might expire in a year or two or be rescinded. So for a couple decades, basically the credit was altered or slightly changed and renewed on a semi-yearly basis. Every 2 to 3 years it would be extended for another couple of years. So it really wasn't on a lot of CPA or companies' radar at the origination of it. So then essentially this is a little bit more of that context. And then we can get into the next slide, which is the omnibus, which started to put it a little more on people's radar. But essentially this first bullet, just a couple slight changes. The greater of 50% of a firm's current year QREs, which is qualified research expenditures. That used to be 64%. And this fixed base percentage, which we'll get into more detail, it's basically a limiting factor in one of the calculation methods. So we're going to get into detail of what those two methods are, a little bit about how they work. But this was previously always 16% no matter what, which basically is a limiting factor of the credit that can be claimed for the current year. You essentially need to take 4 years of your previous gross receipts, the average of that, and then multiply it by 16%. That essentially capped your potential credit. So that was changed here. And then the big thing, the 3%, the second to last bullet point, this was also added where your first 5 years of both qualified research expenditures and gross receipts, that fixed base percentage is 3% instead of 16, which is a lot more advantageous. So the idea with this change was one of the first where it was clear they were trying to be more inclusive of companies that could claim the credit, starting to offer a couple different methods to go about it. So if the original method was not optimal or not possible, you ended up with a 0 or like a negative credit, for instance, not going to bother claiming that. They start to introduce in the early 90s different ways and different calculation methods that a company could go about claiming. And then the big one, ASC, or Alternative Simplified Method, a whole different calculation as opposed to the traditional. So the traditional, like I said, the limiting factor in the calculation is average gross receipts. So if a company hadn't been claiming, their QREs for the year are really low, say like 100,000, but they make 15 million a year in gross receipts. That calculation method under traditional is probably going to offer little to no credit. So they introduced this different method in 2006, where the only limiting factor is your previous year QRE averages. So first of all, if it's the first year you're claiming, you're going to get a lot more of an optimal credit in this instance. And second of all, gross receipts don't matter in this method. They're not taken into account. The only thing that is our previous year gross QREs, so previous year qualified expenses, the average of past 3 years, and 50% of that average. So it was a lot more optimal, first of all, for a company with high gross receipts, second, for one who had never claimed before, and third, for one who is legitimately increasing their R&D activity and thus their expenditures year after year. So this was a big one.
Does anyone use the traditional method now, or is everyone pretty much do alternative simplified? Excuse me.
Yeah, it's still common. I would say about half and half, because also on the alternative end have a company with little to no gross receipts, a startup, pre-revenue, but still is obviously developing something. So that method is usually going to be more optimal, but those who have a healthy business, who have been making plenty of money, but just have never claimed or heard of the credit, ASC is usually going to be more optimal.
Okay, interesting. I get that question a lot. People are like, what's the difference? And it's good to know who should be using it.
There you go. And this is another big one. It finally became permanent in 2015. And another thing, yeah, well, that's basically it. It became permanent. So that was huge. And
it looks like these guys are celebrating by putting sticky notes on the glass. That was their celebration.
I thought that was confetti the first time I looked. But this, I think we experience a lot of CPAs who are really conservative or maybe hesitant because, this is only what, 7, 8 years ago. So clients for sure, CPAs also even maybe still haven't heard of the R&D credit, haven't really considered it, but this was kind of one of the big steps to putting it more on people's radar, especially tax consultants and people on behalf of their clients.
I mean, we often have conversations with businesses and they're hearing about the R&D tax credit for the first time. So I mean, it's my mission at Leyton to educate as many people about it as possible, because if you qualify for it, there's no reason why you shouldn't take advantage of it. It really is a great incentive. Get ready, Chris, because we have poll question number 2.
Launching poll question number 2 now, folks, and it is active on your screens. If a company has only existed for 3 years, would they still be ineligible for credit? Make your selection now, folks, and this poll is active for 60 seconds. Cue the music, Maggie.
Ooh, no, that's not good music. I'll do the Jeopardy. I need to Google the answer. How many people Google the answers so they can be right? Or are people mostly honest and they just do it based off what they're learning? Maybe that should be our next poll question. Or we can save that for the end. How many people have Googled the answer during a CPE course? Devin, have you?
Yeah. Yeah. Or
Devin being honest with us today. Okay, folks, we're going to close down in 3, 2, and 1. Closing and sharing is caring. So we've got 77% at the high majority say they are not eligible. Oh, they are still eligible. Sorry, 77% they are still eligible. It's back to you guys.
If a company has existed for only existed for 3 years, would they be ineligible for the credit? Devin, is 77% correct?
Yeah, this is, I would qualify this as a bit of a trick question. They were formed outside of 1998, which is an interesting way to phrase if they've only existed for 3 years. But even if the company has existed before 1998, they can still claim. So we'll get into one area where that would apply more, where the payroll credit, essentially, who some of you probably know about, or what probably some of you know about, but there's specifications around eligibility for that credit, but any company, even if they were formed before 1998, can claim. It just wasn't the same rules back then, but now it is. So sorry, or everyone was right or everyone was wrong, whatever.
I think the important thing to know is that you can do a 3-year look back with the when claiming the R&D tax credit. So if it's your first time claim, there's a pretty substantial amount of money available to a client, and if they don't have enough tax liability, they can carry forward the credit for 20 years.
Yeah.
All right. Should we move? We kind of just went over this, right?
Yeah.
This slide is my favorite. This one, we'll present this sometimes, and this is when people are like, whoa, wow. This is the qualifying industries slide. So there are some that are pretty obvious. Like, obviously, there's going to be loads of research and development in the sciences. But the areas that get a little bit more niche are like food and beverage, for instance. But if you think about when like a brewery or even someone who's making like snacks or hot dogs, they are constantly trying to improve what their existing recipes. So there's R&D in there just for improvements. Then they're also making new recipes, and that process that they go through to to figure out which recipe is going to be the best and which one they want to go to market with. That's all R&D. So it does end up qualifying. And the way that we approach the credit, like if you have an inkling or you're thinking like, oh my God, could my client qualify for the R&D credit? Just ask someone, ask us, and we can pretty quickly identify if there's going to be decent scope for them to pursue this. I mean, obviously, if they're going to get back like a tiny amount, it's probably not worth like going through the steps to take advantage of it. But there are some like pretty niche industries here that can benefit from the R&D tax credit.
Yeah, just a couple of other things. Like Maggie said, one, a lot of the times all it takes is like a 20-minute, 30-minute conversation with an industry expert to understand if a company is doing something new and novel to them that would qualify. But also like with the food and beverage examples, or dental labs is a good one. I do a ton of dentists and dental labs. And me and Maggie actually kind of endeavored into that industry a few years ago, and it's been really successful. But as long as the R&D is in relation really whatsoever to a product or service, it can be a qualified activity. So like a dental lab, for instance, digitization is a huge thing going on. Introducing new technologies like CAD CAMs or different manufacturing overhauls, and that can also be qualified. So it doesn't need to be a direct improvement or new product, but it can be all sorts of stuff that is making a company better or new or improved.
A good way to think about the who qualifies from a really broad perspective is anyone that's doing something like breaking from their norm, that they're trying to make an improvement, and it's driven out of like engineering, the sciences. So if there's a company that's been doing something the same way for the past 20 years, probably not going to be a good fit. But if it's a company that made some changes in the past 5 years to improve their processes, techniques, then they are going to end up qualifying. This slide pretty much is what we just went over. This tax credit isn't just for labs and software companies, it's for everybody.
Even kombucha companies. Anything
anything that you can improve upon. And it's also like even something as small as packaging. So if you think about like a company that makes a meat and they want to find a way to package the meat so that it can stay on the shelf like a little bit longer, or whatever the thing there is that they're trying to achieve, it's likely that it'll qualify for that tax credit. And you don't need, when it comes to the employees, which I think I'm getting ahead of ourselves actually about who qualifies. But let's break for another poll question.
Polling question number 3, folks, is active on your screens now. What percentage of your clients do you believe operate in an R&D related industry? And this poll is active for 60 seconds, folks. Polling question number 3.
Oh, I forgot the music. Sorry, I was trying to get to the questions page. I hear that we got a question. There we go.
And closing this poll down, folks, in 10 seconds. Thank you all for answering so quickly. In 5, 4, 3, 2, and 1. Closing. Sharing results here. You have a really good split here, but your majority resting at 34% with less than 10%. So back to you guys.
Wow. All right. Less than 10. So I think we've got some explaining to do, Devin, because a lot say not applicable. but maybe it is applicable. So let's continue on and continue educating you guys. So the IRS has this fun little test called the 4-part test that they use to qualify and figure out if a client is truly doing R&D, which this is, I think Devin could do this in his sleep. So I'll kick it over to him to talk about it.
Yeah, I think this is one where the next slide is more detailed, if we can go to that. I'm pretty sure. Yeah, here we go. So I'll just I'm not going to read this, word for word, but there's a couple of these tests that are very close in relation to each other. I would say actually 3 of the 4. So technological in nature is essentially based in the hard sciences, quote unquote. So really, you think of anything in the category of science, medicine, dentistry, physical therapy, manufacturing, IT, computer science, engineering, chemistry. Really, that's a pretty straightforward one. And then the technological in nature, then technical uncertainty and experimentation. Those 2 kind of go hand in hand. So if there is uncertainty within something that a company is trying to improve, they're usually going to go through some sort of process of experimentation to achieve their goals or figure out what the hypothesis answer is, or whatever you may phrase it as. But that can be trial and error, just process of elimination. Try one thing, see if it works. It doesn't, move on to the next. But if there's uncertainty, that's basically the essence of R&D. You're going through research and development to try to figure something out, how to make your product better, how to improve a shelf life, how to make your products more efficiently, etc. And the key thing that all of this revolves around is the business component test. So basically, the IRS specifies that any R&D needs to be in relation to what you're selling as a company. So your service, product, or like I said earlier, some internal process that still ultimately is connected to what you're selling. You're trying to make something more efficiently or less costly, trying to reduce headcount and make something quicker. Whatever it may be, ultimately, we just need to prove that it's in relation to something you're selling. So that is the business component. That's your company's product or service. And these 3 categories are more easily met just as long as they revolve around that business component test.
So how do we make this into a profitable experience for the client? What money can we include?
So money, it's all based around expenses of the company, and there are 4 categories. So salaries and wages, 1099 or contractor expenses, supply costs, and then what was originally called in the code computer leasing expenses. So in the past, that was more centered around like physical servers for like an IT or computer science company, a software company. Now it's more so framed around AWS sort of costs, cloud computing costs. So that can't be routine maintenance or hosting related, but any portion of your cloud computing costs that you're using purely for R&D can be included. So those are the 4 overall categories. Just to go a little more in depth on a couple things. Wages, that's just going to be W-2 box 1. So that's going to be part of our, or anyone's documentation request, looking at who the employees are. Essentially their titles and their activities need to be technological in nature. So finance, admin, marketing people aren't going to qualify for R&D. Little tidbit is that partnerships, that second line item, employment income and some guaranteed payments included. So if it's a company partner, like an entity who owns another entity, we're not going to include any of their K1, Box 1, ordinary income or guaranteed payments because they're not an individual. But other than that, if they're an active partner, they're partaking in R&D, those payments can be included per the code, the definition of self-employment income that can be treated as a wage for this purpose. And then we'll get into contractors. There's a couple more stipulations around if a contractor is qualified as an expense for a different company who's using them and claiming the credit, or if the company is a contractor, can their work for other people be qualified? So we'll go into a little bit more detail about that. And then supplies is pretty self-explanatory. Like if you're prototyping a new piece of machinery or a new product, you're going to have a lot of first batch run, trial runs, prototyping expenses, tooling, all that sort of stuff, as long as it's not capitalized, can also be included. So 280C, the essence of this, first of all, is that if you're claiming a credit, you need to back out the expenses on an amended return. So you can't be double counting using the same deductions that are on a return for what you're using for a credit. So that's on amended returns. Basically, there's a statement with which you back out deductions in the amount of the credit you're claiming, according to the cost categories that you're claiming for the credit. So if you're claiming 100,000 in wages, and that equates to 10,000 in wages actually going towards the credit, then you need to back out 10,000 in wage deductions on the return. The main thing here is a note that you can basically make the selection for current year filings. You can reduce the credit in real time instead of going back and backing out those expenses. So not only is that a little bit easier and simpler and it saves some time, but also it affects avoiding increasing your state tax liability or your client's state tax liability. On an amended return, if you need to back out deductions, your taxable income increases on the federal return, then the state has to match that. So all of a sudden, if you're claiming a credit, you owe more in state taxes. This avoids that. So us, for instance, we almost always elect the 280C election for current year filings. Unfortunately, it's only eligible for that current year filing. So amendments, that's what this is explaining, the need to not double count expenses. Okay, so wages, just a little more detail around who can be qualified. So like I said, first of all, technological in nature. You're going to avoid all those kind of admin or not related roles. But the important thing is also you can claim wages on 3 parts. So someone aware and performing an R&D activity obviously is going to be qualified. And the way that they're qualified would be to take an estimate of how much time during the year they spent on those R&D activities. But you can also take a level above that and a level below that. So supervisory, there might be like a CTO or a CEO who was heavily involved in the planning and development stages of an R&D project. They can also take their portion of their time in which they were doing so, or just purely supervising and collecting data on the project as it was going. That's qualified time. And then support staff. A lot of support staff, take the dental lab example, for instance. There's a lot of people on staff who aren't aware that an R&D project is occurring. They're just kind of doing their daily job, but they're helping carry out the project or the experimentation. So think of like in the super cliched example, like a lab with a bunch of scientists and they're creating some formulation. Support staff would be like someone mixing the chemicals or the juices or cleaning out the beakers or anything that is technological in nature, even if they're just doing their daily job, it's basically the same thing. It's an estimation of how much time they were spending on that project, regardless of their awareness or true involvement in it.
A good way to think about it is if whatever the project is that we're trying to qualify, if there was someone who was contributing to it and they wouldn't be able to like complete their project without that person, like they need to have clean beakers. So we can include a portion of that that staff, or they need to have like a certain level of cleanliness within a lab to have it be like a true experiment, or one that would pass the FDA. Then whoever's contributing to that, and also the supplies that are contributing to that, can often be included.
One more thing too, it's just because a lot of you guys seem to be claiming this with your clients, or maybe are interested in doing so. One question we get asked a lot is like, do I need time tracking? How do I know what people spent on this? The IRS allows for a reasonable estimate. So the way that would go in an audit is essentially, sometimes the IRS would pick employees at random who have qualified time per their kind of IDR, or follow up with the client as to what they claimed and who was claimed. If that can be corroborated, say in a 10-minute interview, like, okay, did you actually spend 5 or 10% of your time on this activity? Then that's all that the IRS requires. They don't expect every client claiming or every company claiming to have by the minute or hour time tracking. That's something we get asked a lot.
So Devin, we've got a question here that I just wanted to bring up about how this is obviously complicated, right? And if you were a CPA firm and you weren't, outsourcing the work to someone like Leyton, how would you go about actually figuring this out? Do you have any tips to share to firms who want to try to do this on their own?
Yeah, so I would just, you guys know the industry, obviously, that your clients are in. I think a 5-minute conversation with them initially as to, okay, regarding your business and what you sell, have you done anything new in the past 3 years? If something very clear, new and expense and time consuming, I would qualify that as. Something very clear comes to mind. We had this, we were working on this, we were overhauling this whole manufacturing process. Yeah, we just filed a patent for this. We just came out with this new product last year. Anything new within the company is going to be a pretty good indication that they probably have been doing qualified work. Then, if it were an outsourcing process to us, then I would just say schedule like a half-hour call with Maggie and she can point you in the right direction. But if it's something you want to do internally for your client, that would be, I think, the first conversation to have.
And any tips on how to properly segregate the costs that can go to R&D and then ones that you wouldn't put in the R&D credit?
Yeah, so those 4 categories obviously would be the first kind of segmentation. You don't need to think about, I'm blanking on a different cost that are not those 4, but that would be the first thing. And then oftentimes that's really difficult to do retroactively. But once the company claims a year or 2, they figure out the process of needing to go back and estimate how much time and money was spent on something. They start to be a lot more proactive in tracking that throughout the year. So a lot of times with a repeat client, we'll see that they have just an R&D expense line item on the P&L. And if we dig into that, they've been kind of informally tracking time, or they know for a fact that this certain contractor, all they do for this client is R&D, so they put them in that bucket. They'll put the very obvious supply costs like prototyping expenses in there. So my brief answer would be that's tough to do retroactively, and that's kind of what we help on throughout the engagement. But once they get the idea of, okay, especially for time and employees, we need to do some sort of weekly or monthly tracking as to how much time people are spending on this project. internal tracking of any form just on an Excel file or anything is totally fine. It actually helps quite a bit as long as it shows that that was being tracked in some way.
Okay, thank you. And we'll try to breeze through some of this. I thank you guys for all the questions you're asking. I don't think we're going to be able to get all of them answered in this live session, but we will answer them for you. I think the most popular questions, Devin, I don't know if you're looking at it, is
No.
like examples of stuff that qualifies. So again, I dropped a meeting link in there. If you guys want to book a private meeting with someone, they can answer your questions as well. But we will get them answered. But
yeah, so I'll go
back
quicker.
to the show.
Yeah, I'll go quicker now. Because yeah, us two, between me and you, Maggie, will have plenty of examples of clients we've worked with and stuff. But real quick on the contractors, there's basically two sides. Like I explained earlier, whether the client's a contractor themselves and does that work qualify, or the client's hiring a contractor and can they claim that cost of the contractor. So the main issues are, first of all, rights to the IP or the R&D, which is a little more straightforward, and then financial risk. So if a client is paying a contractor and they want to claim that expense, basically we would like to see them paying the contractor on a T&M or time and materials variable basis based on how much time is being spent, with no acceptance clauses. So the idea is that the risk is on your client who's paying the contractor no matter what, regardless of the work being performed or the success of the work. If they're paying on a fixed fee basis and there's an acceptance clause where it says we're only paying you if the work is successful, then the financial risk really is not on the client. So that's one thing. The opposite, the client being a contractor, and can we claim our time even though we were a contractor for someone else? We would like to see essentially the opposite there. They're working on a fixed fee sort of engagement or a retainer or something where the project might end up being more time and expense inundating than what they signed up for, and it might not even end up being a profitable engagement. Say, they get paid 20 grand no matter what, and they ended up spending what would equate to them as like 40 grand worth of work. The financial risk was on them to complete the work, and they either retain IP and their kind of work product throughout the engagement, and they just sell like a final deliverable. Yeah, that's essentially it. The big thing is analyzing the letters of engagement between a contractor and a payer to see who the financial risk is being put on.
We found too that some people might think that it's like a time and materials letter of engagement, and then when you actually dig into it, it's not the case, and then the funds can be included. So it's always worth having like someone with a legal background analyze the contract, because you could be missing some like pretty significant dough that you could be putting into the claim. Now let's talk about what we cannot include. So what activities do not qualify?
Yeah, so it is essentially anything not technological in nature is the easiest way to think about it. But also a couple stipulations, like the first bullet, for instance. If you've developed a product and you've gone through the prototyping phase and now it's being sold as is and it's in commercial production, then that's a pretty clear indication that the uncertainty is not present anymore. The key thing there is that any like big version overhauls or updates, like V2 of a software, or a significant change to a product that was already in production, that's going to go back to being R&D. But that's one. And then a couple of the more obvious ones, like social sciences, essentially, surveys, market research, data collection, anything where you could say there's some uncertainty. Maybe you're trying to figure out your client base or your customer base's interest in a new product you might develop. But it's not necessarily technological in nature, and it's not yet at least tied to any business component. The couple of the other ones, funded research mainly means if a company received a grant to do R&D, then we can't include that. That's back to kind of the financial risk. You need to be like taking on an endeavor to figure out something new, not being paid for. And then the conduct outside of the US. So that actually is a big one, especially for software clients. The work physically needs to be in the US, and people on staff need to be located in the US. So we'll get a lot of software teams or development teams overseas, India, China, whatever it may be. Unfortunately, those costs also can't be included, which goes back, I think, to kind of the essence of the credit and wanting to reward like US-based innovation, create US-based jobs. That is a key thing to keep in mind.
All right, Chris, run the poll.
Polling question number 4, folks, is active on your screens. Will a company be subject to higher tax audit if the R&D tax credit is claimed on the federal/state returns? Make
Oh
yourself
wait, I have a different
folks.
polling question up. We have a disconnect, guys.
I guess this one's.
Do you mind repeating the question, Chris?
The question that we have here is, will a company be subject to a higher tax audit if the R&D tax credit is claimed for on the federal state return?
Okay, thank you.
We'll close this poll down, folks, in 3, 2, and 1.
All right, almost 50-50.
Back to you guys.
Thank you. Sorry about the mess up here, guys, about this poll question number 4 on the screen was probably easier than the one that you guys got, so sorry. But Devin, I guess you're probably best to speak to this, to audits and
Yeah. Bummer on that one. Yeah, everyone would have aced that, I think. The audit one. So kind of like a double answer as well, just like one of the other questions. Amending a return statistically increases the chance of it being looked at just a bit, but that's not in particular because of the R&D credit being claimed. So the R&D credit is not like a flag for the IRS. It's not, they don't have any sort of software that designatedly says a company is amending and claiming this, we need to look at this. The chances, because you amend, I think statistically go up about 3%, which I'm sorry, I forget if I just said that. But also claiming in a current year, essentially there, at least what we've seen, there's no increase in audit risk. And I personally, like I said, I've done at least 500 R&D claims for different clients, and I've yet to encounter a federal audit. I have encountered probably it's up to 5 state audits. So I would say claiming in a state entails just a little bit more risk, which makes sense. I mean, they're probably more properly staffed and have less of a budget to hand out with these claiming for refunds. So they're a little more vigilant about it. But to the question, it's very little. It's a minimal risk, particularly if you're claiming for a current year filed return. But even with amended returns, minimal increase in risk.
Thank you. That makes total sense. And we have the way that we approach our studies is making the assumption that everyone's going to get audited. So we
Mhm.
author a super long report that coincides with the activities, and we've got like a big team of sector experts. So we've got doctors, software engineers, all these various people on staff that have expertise within the given sector, so that we're doing it right the first time. We don't want over, nature of consulting, I suppose, you're like over prepared.
Yeah, just real quick, like what I've learned, I feel like over the past 3 years is that there's really not a ton to be scared of with an audit. We're doing all this work and making sure that the projects are qualified in order to defend an audit. And oftentimes these are agents, whether it be IRS or for the state, that just want some more detail and want to make sure that this claim isn't ridiculous. So they're interested. They're nice people too, and they're just gathering information to verify that something just completely out of bounds wasn't claimed.
Makes sense. All right, we've got 9 minutes left, so maybe we just zoom through this. I feel like we could probably zoom through this slide. These are
Yeah,
the tax forms.
this is straightforward. This is the sort of thing we would need for the calculation and the expenses, everything you would think, P&Ls, W-2s, tax returns.
And then this is just the rules of the credit.
The only thing to note is that if your client wants to claim and they're not profitable yet, so they're not paying taxes yet, the credit can be banked and carried forward for up to 20 years. So it's essentially a tax asset. And that's it.
And there's no, well, I guess we should mention there's no amount
Oh,
that
yeah.
you can, there's no like cap on the amount of money. So if you had an R&D tax credit for $100 million, it's yours. Or
Yeah.
if it was, $100, it's also yours. And then this map highlights the states that have the credit. I believe the navy blue are the ones that have a credit. Right?
Yeah. Yeah. So yeah, a lot of states offer it, a majority. And the only things to keep in mind are really that almost every time it's a very similar calculation method to the federal, and it's the same criteria on the technical side. The states aren't changing a whole lot as far as how it's calculated or how a company would qualify. But yeah, this is a great picture just to show that there's very few states that don't offer any sort of program at this point.
And the payroll tax credit for the early stage business. That should be a poll question. How many people focus on early stage businesses? Yeah.
The key thing to note here is that this is basically a different mechanism to claim the credit. So like I was just saying with the carry forward option, there's also an option only on current year filings to check a box and basically use the credit to offset your company's payroll tax going forward. So that's not an amended 941. That's you claim through a certain form, provide it to your payroll provider, and then payroll taxes are offset in the next quarter going forward until the credit is exhausted. So that's a great way, for a startup who's not paying any tax to still see a benefit here. And the criteria are basically, a few fold. One is you can't have had gross receipts for over the past 5 years. So if you had sales of any amount back in like 2010, you're not going to, and there going forward, you're not going to qualify. The second one is so, say you've started in 2018, you're still eligible based on that criteria. Another one is you can't have had over 5 million in gross receipts for any of those years. So those are two. 5-year window, not more than 5 million. Then the last thing is that credit is capped to 250,000. So you can still, reach that cap in the payroll election and then take an extra generic R&D credit. Say you had $1 million in credit, you could bank $750K and take that maximum payroll option. But yeah, just keep in mind it's only eligible for current year. So unfortunately, you can't amend and claim the payroll credit.
This is good to help early stage businesses who don't have an income tax liability, but have a W-2 payroll. So if you guys are also advising companies on like an early stage business where it makes sense, you can advise them to start with W-2 employees, and then they can use this to offset their income tax liability if they're going to be doing R&D. And I mean, depending on the business, if it's, you know, they probably will be doing R&D, unless they're like professional services. All right, now we're going to get into some case studies. If people can hang on for a few minutes, we'll run through them. And if not, please book a meeting with us and we can go through. We had a few other things to go through, and we did want to talk about the new amortization rule or ruling. So we can also schedule time with people to talk about that, not in this scenario since we're running out of time. So the first example we have here is an engineering firm, and the credit they got back was $130,000. They had 14 employees, and took about 1 month for us to do the study. And the work they were doing was improving and developing new structural design, or I guess this is just engineering in general, not specific to this actual case. Their key R&D products were technical requirements gathering, schematic design and development, prototyping and testing, and manufacturing process development, fixed fee engineering projects. And then this one, actually, this is one that Devin and I both worked on. This was a company that builds, have like a software kind of similar to Kayak or Expedia. They have like a number of, like a way to find a cheap flight, best flight. And in their first year of claiming it, and I think it was the R&D tax credit, not payroll, they got back $430,000. They did a 3-year look back. But Devin is still working with them on their studies, and I think you were saying the other day that they're now like it's gone up and up each year, obviously, as their business grows.
Yeah, they went from like 2 million in gross receipts 3 years later to 25, and they're paying like 2 million in taxes just at the C Corp level every year. So they love it. They love this credit.
Yeah, that's a lot of tax dollars. And then when we do work in partnership with a CPA to go through and claim the R&D tax credit, we still need the CPA plays a huge role. We need the tax documents. If there are any implications on amending a tax return to the business's like personal side, if they're an S Corp, it's really helpful to know that so we can help mitigate any of that like excess cost. And it also helps to like speed the process along if a CPA can be with us along this journey. And I mean, as you guys can tell, this is pretty complex, and this is a huge section of the tax code that this is our bread and butter. We've been at this for 25 years. We've got about 3,000 employees, and their focus is on the R&D tax credit. Everyone gets trained on it. And we do support other credits as well, but this is our, where it all started and where it still is. So I will, we're just at time. If we can, we're happy to field some questions. I think we have a couple of minutes. I don't know if you have time, Dev, but we're happy to talk through that.
Yep, definitely.
Chris, can you open the mics, or how should we do questions?
The attendees are not able to answer questions via any kind of audio. They can only ask questions in the questions panel.
Oh, okay, that makes sense. Well, I'm in it. So can profitable companies use an unlimited amount to offset income tax liability? Isn't that the IRC Section 38 limitation restricts the amount of tax liability that can be offset to the greater of either the tentative minimum tax 25 or any tax liability greater than 25,000? That
So
one's coming from you, Devin.
there are limitations here and there, AMT wise or TMT wise, with individual shareholders, owners who I believe who are making more than $1 million in AGI related to the company claiming. In which case, yes, it's not limited to what they can claim on a current year, but the utilization of it is going to be extrapolated over a longer amount of time due to those limitations of what can actually be used each year. There's definitely no limit to just claiming a regular credit and having that on the tax return. With TMT and AMT, there are some limitations in when that credit passes through to an individual's return, how much can actually offset their tax liability for that current year. Then you have that situation of 20 years of carry forward opportunity. So I think it's probably very seldom. I've only seen it a couple times, to be honest. So I'm not an expert in that, but it's probably pretty seldom where you're actually going to lose out on any credit as a shareholder. Just a timing difference.
Hey guys, we are at time. We're gonna go ahead and just wrap this up for everyone, if you don't mind.
Okay. Well, guys, thank you so much for taking the time to chat with us today. We really appreciate it. Or not chat, no one got to speak except for us, but listen. Thanks for listening. And we are hosting one next week about ERC. That's Wednesday at, I think, 3 o'clock. So please join us in person if you're in the Boston area, and join us virtually if you can. And that one's about ERC calculations. It's a serious deep dive into ERC. So we look forward to seeing you there. Please schedule a meeting with us if you guys want to talk more. And have a great weekend.
Fantastic, folks. Thank you guys so much. We here at CPA Academy are going to wrap things up as well. Your credit will be processed today and will be available within 24 hours. Each of you will receive a full webinar evaluation that will come to you via email and in your account. Thanks again to our presenters, Maggie, Crowley, and Devin Medjuk, for a wonderful presentation.
Thank you.
Thank you, everybody, for coming and spending time with us today. We do indeed look forward to seeing you at future webinars. And everyone, please have a wonderful rest of your day.
Bye. Thanks.